A good day to you, ladies and gentlemen, and thank you for making the time to join us at this time for this webinar hosted by Grant Thornton Bharat. My name is Vishesh Chandyok. I am the Chief Executive Officer of Grant Thornton Bharat. I am delighted that you could make the time. I'm also delighted that we'll be joined by an illustrious panel this afternoon. Not too many slides, actually no slides, but for you to learn and hear from real experts about this space of ESG. Bharat Madan, Group CFO of Escorts Kubota, Full-Time Director, as well as Django Dalal, co-founder of Gaviva, our strategic alliance partner on the space of ESG. We will also be joined by Abhishek Tripathi and Dinesh Anand, real ESG leaders in this space from Grant Thornton Bharat. And today's subject at this webinar and this series of webinars that we intend to host will be on value chain reporting. Now, I sit on one listed company board and just one listed company board, and with the stock markets where they are, as one would imagine, questions from shareholders are not about company performance these days. I attended the company's AGM just this morning, and there was only one question that somebody asked. And I was amazed. This is a small shareholder somewhere in a tier 3, tier 4 city in India who asked, "Sir, may I know what your company's ESG rating is?" Only one question. Everything else was compliments on how well the company is doing. So I think I can safely say that ESG is fast going from that noun ESG to a verb where people expect action. Our purpose at Grant Thornton Bharat is to shape not just a bigger India, but a better India. And to shape a better India is directly linked to making progress on ESG, that verb. ESG, to me, in its simplest form, is the need to break down the E, the S, and the G into that climate and energy transition, the scope 1 to 3 emissions on the E, the diversity, equity, inclusion, health and safety, which is so central, particularly in professional services firms with what happened recently, and something we are acutely aware of on the S, and of course, all the pillars of governance that come together and actually not just create value, but preserve value, sustain value for a business. That is what I consider ESG. But today is about value chain reporting, VCR, as you would call it. And this kind of VCR is not unique to the world, but the need to get 250 top companies to consider the ESG impact of its value chain, both upstream and downstream, and as much as 75% of that, and then also get auditors to attest to it, is unique to India. And we will be the first ones to make progress on that. I know all of you have more questions than answers at this time, but we've got to look at the enormous opportunity there is for us as a country and for each industry within our country to emerge as a leader globally if we were to even make 50% progress on that objective. So I compliment you for taking time from your busy schedules to be with us this afternoon. And once again, thank Bharat, Django, Abhishek, and Dinesh for hosting this webinar series, and this beginning with webinar 1 on value chain reporting.
Thank you, Vishesh, and welcome everyone once again to our first of many of such webinars which we are going to be doing going forward. Our intention today is to give you an industry perspective on value chain reporting and the practical challenges and implementation, and for this you will hear more from Bharat. You're also going to hear about how technology can really streamline value chain reporting and enhance transparency. And this is something which Django will cover. And finally, we will share some trends with you on value chain reporting requirements and the recent recommendations on BRSR by the expert committee. And this is stuff which is going to be covered by Abhishek. But before we start, I would like to really have a quick fun poll. You will see a poll pop-ups which will pop up on your screen shortly. Please select the option that you think is the right answer. Can we start by putting up the first question, please? You all have to just select your answer and click on submit. Bhavik, can we get the answer, please? So we have 32%, no, 7%. So the right answer for this is answer C. So there are 61 key KPIs which are what everyone needs to report for value chain. Let's go on to question number 2, please. Can we put up the answer, please? The answer. Absolutely. I think the audience has got it right. All of the above is the right answer. Can we go to the next question, please? Please put up the answer. I have to say that we have a great audience who is extremely learned. The answer is absolutely false. Let's go to the next question. The answer, please. Excellent. The right answer is 75%, which the majority of the people have got. And finally, the last question, please. Can we see the results, please? And actually, the right answer is all of the above. Thank you for all your participation. It is really interesting to see how your perspective aligns with some of the key themes which we will discuss today. As we are going with the webinar, please feel free to post questions which you have in the chat box. And if we have time, we will pick them up. If we do not have time, we will still pick them up and we will make sure that you by email receive answers to all those questions. With that, let's straight away dive into our panel discussion. The first 2 questions are going to be aimed at you, Abhishek. What are the current value chain requirements and what metrics should companies prioritize? You're on mute, Abhishek.
So, Dinesh, as we all know, the BRSR brought about a 3-dimensional shift in how ESG was being handled in India. The change was in terms of the location, theme, and the people discussing BRSR or ESG. The location of ESG discussions shifted from the remote plant location to the boardrooms. Theme of these discussions shifted from ensuring health and safety for workers and employees to how ESG could be integrated with the business. And the people discussing ESG changed from the EHS heads against the plants to the CXO and the board members. Now, going forward, SEBI has also mandated ESG disclosures for the value chain, starting with the top 250 listed entities, of course, for market capitalization on a comply or explain basis for the financial year 24-25. These listed entities now have to report on the KPIs as per the BRSR code on the value chain to the extent of the business attributable to this value chain partners, both upstream and downstream. The key indicators on which this disclosure is required to be made is greenhouse gas emissions limited to scope 1 and scope 2, water footprints, energy footprints, circularity, which is waste generated by types such as plastic waste, e-waste, hazardous waste, etc. Employee well-being and safety, so the expenditure incurred on employee well-being and safety and the measures taken by the organization on employee well-being and safety. Gender diversity, including complaints related to POSH, inclusive development, where one has to report on the input sourcing material purchased from the MSMEs. Fairness and engaging with customers and suppliers, so data breaches and days of accounts payable qualify there. And the openness of business, which is purchase and sales done with trading houses, dealers, related parties, and as well as loans and advances and investments with related parties. Now, this focus towards the value chain becomes critical because most of the environmental and social risks often lie upstream in the areas such as raw material sourcing, manufacturing, transportation. And by integrating all of this into the value chain reporting, now the businesses will not only comply with BRSR, but also get a holistic view of the entire supply chain, or rather the value chain. And this would just further build stronger image. They can get into more responsible partnerships and mitigate ESG-related risks. So I hope this covers
So,
the
as a
answer.
matter of fact, in continuation to that point, in May of 24, SEBI has released a consultation paper, right, where they have proposed significant changes to the BRSR framework. Can you talk a little bit more about what were the proposed changes and the impact on compliance for companies and how companies should be looking at that consultation paper?
Yes. So while the disclosures, the requirement for disclosures on the value chain came in last year, but then there were representations from industry groups, corporates, asking SEBI to kind of be lenient on the disclosure requirements. So SEBI had set up an expert committee to get representations and feedback from the industry. And based on that, SEBI released a discussion paper. Now there were three important considerations on the value chain disclosures as per this particular discussion paper released by SEBI on 22nd of May. The coverage of value chain was limited to 75% of the value chain, both upstream and downstream, covering every value chain partner which accounted for 2% or more of the total volume of purchase or sales, and the disclosures on a voluntary basis as against comply or explain as per the earlier notification by SEBI. These proposed changes to the BRSR, particularly revising the definition of the value chain partner and introduction of the voluntary disclosure, is going to definitely ease some burden on the reporting entities, the top 250 listed companies. Further reducing the scope of the value chain partners to 2% or more of the company's purchase or sales will also kind of significantly ease the reporting burden, because then the reporting entity doesn't need to go to the 100%, cover 100% of the value chain. And this would become important for companies who have a very complex and vast supply chain. It will further prevent small suppliers and downstream partners from facing undue compliance costs, because all this comes with a cost. And this could be challenging for SMEs because lack of resources or systems to report on the ESG parameters. So the shift towards the voluntary disclosure, also the shift towards the voluntary disclosure for the first year, will allow companies to get more time so that they could set up a robust system for data collection, validation, and reporting. So more or less overall, this will simplify compliance and reduce the immediate cost burden.
So, but if my understanding is correct, there is no official notification at this stage. So while there is a consultation paper, at this stage, companies still need to view the original notification which exists, which is that you need to report as per the previous directive if you are in the top 250. I think one of the key takeaways I would also say, and based on all the conversations we are having with clients, is that, one is, don't just look at it from a compliance perspective on reporting based on what SEBI is saying. We are also seeing that now there is a lot of demand or a lot of ask which is coming from the foreign investors as well as from countries or clients which a lot of these companies are serving as part of the upstream partners. So the sooner companies start, earmarking their value chain and putting the data which is required, the easier it will become. I think now moving on to Bharat, and Bharat, how has the BRSR mandate influenced your company's approach to engaging with suppliers and partners on sustainability issues?
Yeah, thanks, Dinesh, and good afternoon, everyone. I think as you mentioned, Dinesh, so obviously there's a lot of focus, especially if you are also a multinational company. So you're not only looking at the requirement from a local perspective, there's also the parent, whose country may be enforcing these initiatives in a big way. So I think the similar impact gets felt in the subsidies down the line. So the BRSR mandate has significantly amplified even our focus, on value chain engagement and collaboration. Now we actively seek partners, especially when we are onboarding them, especially upstream partners who align with our sustainability goals and are committed to transparent ESG reporting. Now this shift obviously has led us to prioritize long-term relationships with our partners who share our vision for sustainability. Now to support this, we have initiated comprehensive capacity building program aimed at assisting our suppliers and dealers in enhancing their sustainability performance and data collection capabilities. Now, these programs include training sessions, jobs, and access to digital tools that stimulate data management and reporting processes. Now, by empowering our partners with necessary knowledge and resources, we are enabling them to meet the stringent requirement of the BRSR. Moreover, the BRSR has transformed our approach, from a purely transactional relationship, we used to be the case earlier, to a more collaborative and value-driven partnership with our value chain. Now we engage with them through regular dialogues, to understand their challenges. Now the collaborative approach not only improves data accuracy and consistently, but also fosters a culture of continuous improvement, and mutual growth. So I think the way situation is today, we don't think, in the long run, there'll be any exception to this rule. So it used to be a compliance requirement, but I think from the business continuity perspective, now we think this is now becoming something which is mandatory and you can't do away with this.
No, thank you for those valuable insights, Bharat. And I think more than that, being a compliance requirement, I think what those companies which start going down this path are actually going to see that there is a competitive advantage that they're going to get. And I think the sooner the boards realize that there's a competitive advantage when you look at ESG and not as a cost of compliance, the whole journey becomes far more easier to implement, right? Not just within the company, but also to your value chain. But it is evident that, the BRSR mandate, and we've got to compliment SEBI for taking out BRSR, because had they not made BRSR reporting, I think a lot of companies would still be lagging behind on how they report on the ESG performances. But it's really great to see how it's reshaping how companies are engaging with their suppliers and customers on sustainability issues. Django, besides the regulatory requirements, right, do you see any other drivers pushing companies towards sustainable and ESG-driven value chains? Like Bharat has mentioned, are they really seeing the value and benefit of going down this path, or are they just doing this because they have to?
Thanks, Dinesh, and good afternoon to all the participants on this webinar today. Dinesh, as you know, we started the Gaviva ESG digital journey about 5 years back. And in this period of time, I've had the good fortune to meet a lot of industry captains, practitioners, consultants, and wise people like we have on the panel today. It's quite surprising that for a new concept, ESG is accelerating pretty rapidly in India and globally as well. From a point 5 years back where organizations were, kind of just getting their internal acts together, today we're already talking about going to their boundaries outside. And to your question, what's driving this? Of course, it's the regulator. SEBI has been on the forefront over here. But even if you look at it globally, in Europe now, they have the ESRS, which the companies, European companies, have to report for the period January 1 to December 31st for the current calendar year, which is going on. Whilst the European companies have to mandatorily report that 2,000 disclosures, these are listed companies, companies having more than 500 employees, etc. There's also nuance over there that any company, even if it's not an EU company, if it is operating or has revenues which it accrues in Europe and cross $150 million, they too have to do the ESRS. And if you look at the ESRS also, out of the 2,000, there are almost 30% which is focused on the value chain. So of course, the regulators are driving it, and very rightly so. But to your question, beyond that, what we're seeing is customers, clients, practitioners in India who serve global markets or who serve export clients or large global multinationals are also very rapidly adapting sustainability in the supply chain. Let me give an example of a very large transportation and logistics company that we work with. It's a multinational, true Indian multinational in that sense, present in 160 countries. Now they downstream provide services to large marquee clients across the globe. But when they are providing those services, whether it's surface transport through trucks, mid-sized vehicles, or water transport through ships, or airborne transport through aircrafts, etc., they don't own those assets. They get it from upstream value chain partners. And for this company to serve their downstream customers, it's extremely important, and they've been doing it for the last 2 years, to get data, manage, and monitor what that Mr. Singh with 15 trucks and then a larger shipping company or a larger DHL, which gives freight services, is doing, because they need to integrate all of that, present their scope 3 as it were consolidated to their upstream market clients. So it's an absolute business necessity beyond what the regulator is driving. Another example I can share with you is from a conversation I had a couple of weeks back in Chennai with a very large South India-based auto ancillary company. This company provides a very critical part of commercial vehicles as well as passenger vehicles, and about 70% of what they make is exported. They were telling me that somewhere around April this year, from one of their large marquee European clients, they got a communication which had a questionnaire which had about 37 odd parameters which this auto ancillary company had to respond to. And each of those 37 were about this company's upstream value chain. So it's all gathering momentum. And if you try to think, why are regulators or clients abroad or even large clients in India pushing so much companies to go from within to external boundaries? Why the value chain? I would give you a small example to answer that. A little controversial for Indians, but the European carbon tax, when it first got announced and all of us read about it in the newspaper, in essence, if you peel the onion, what the EU carbon tax is saying is that, hey, European company, if you're getting products or commodities like steel or any products made from commodities like steel, etc., as part of your purchases, please ensure they are either sustainable in nature or impose a carbon tax. And why are they doing that? They want to ensure that large companies don't kind of outsource their ESG problems upstream, downstream. And I think that's what our regulator, SEBI, also has in mind, that you keep expanding the boundaries so that everyone's included. And in an indirect fashion, you also start making the smaller companies a little aware of ESG becoming a key requirement. To the second part of your question, Dinesh, about benefits, I think from the examples which I mentioned, retaining customers becomes a critical issue unless you're addressing your sustainable supply chain. And then if you flip it and make it into a competitive advantage, when you're bidding for newer businesses, you will obviously have an advantage over someone else who's not doing that. So to answer your question, and for everybody on the panel here, yes, the regulator is critical. Investors are absolutely driving it, as Dinesh and even Bharat mentioned. But the whole thing about buyers, large, medium, small, driving you to do it is a key driver as well.
No,
Thanks.
thank you, Janko. And I guess the takeaways from this, what comes out is obviously the regulatory push, domestic and international. CBAM, which you spoke about, right, which is driving the whole carbon tax. Of course, and then comes the international clients and also the investors. I think another key point I would take from what you said is that, so far we've done a very good job, at least when I see a lot of our clients which we speak to, they all are talking, they've been able to map out scope one and scope two. But as they look at their value chain and the upstream, scope three is becoming extremely important, right? And everybody avoided doing scope three, but now it's become very important that scope three starts becoming the same way as scope one and scope two, which we did. And that would just make the entire value chain far more easier to map out. I think just building from this and coming back to you, Bharat, what have been the primary challenges you have faced, right, when implementing value chain reporting?
Yeah, Dinesh, I think you took this poll in the beginning, and then you had mentioned those challenges, and you said the answer is all of the above, and the answer actually is all of the above. So it's not one or two. So I think the issues are, I think, across all category. So I think if you look at the value chain, there's both upstream, downstream. In the upstream, at least you got the suppliers who are catering to, multiple OEMs, and they are facing the similar issue from all those OEMs. And they are non-exclusive, for you. But when you go to downstream partners like company like us, got 1,500 dealerships, and they are still all exclusive dealerships, you have a bigger challenge because first educating them, because no one is going to educate them other than you. But you as a corporate has a responsibility to do that. So that's a bigger challenge. But in upstream partner, there are other OEMs also who are actually, buying from those suppliers, so they get educated from various, different OEMs. So that is one thing which obviously is a challenge. So the second is, even within the upstream partners, obviously there are some who will be already in the listed space. Like if you got more than 1,000 suppliers, who are catering to our requirements, only less than 5% of them are listed, which actually knows these requirements. So balance 95% which are unlisted, and many of them fall under SME category, is a bigger challenge. First them, the cost of compliance itself is very high. Then they're not used to capturing this data. So data management and collection becomes a major challenge, for them, which is a bigger task. And then educating them how to capture and make sure the data which they captured is accurate, transparent, and is consistent with what other suppliers are really, reporting. That's another big challenge, which really needs to be taken care of. So I think it's a combination of all these factors. I think what you mentioned, I think in the poll, which is rightly captured. So it's not an easy task, especially from the small SMEs sector. Cost of compliance is very high. They have not been used to reporting non-financial data so far and capturing it. And suddenly they have been, made to report this, whoever is catering to these large companies. So I think it's a bigger challenge now for them to manage these compliances. And I'm sure the companies, large corporates need to play a bigger role, and maybe along with government, some agencies, in terms of educating and making sure these compliances are taken to the right level.
No, thanks, Bharat. So I think what's coming about is really how do you educate, how do you make your value chain partners, especially the upstream, more aware, upstream and downstream, as well as training. Of course, Django, maybe that's a key takeaway since you are in the technology space. What can you do to, come out with an automated, simple tool which actually the value chain partners can use not only to get aware but also be able to do a lot of the meet the requirements on reporting on the various parameters which they would otherwise be lost on how to do it. Coming back to you, Abhishek, maybe some of the key challenges which you have seen some of our clients encounter, as they have gone to integrate ESG principles across the value chain. And what is your view on how prepared are they to manage and report these ESG requirements through their value chains?
Sure, Dinesh. So let me start this with saying that now the discussions on BRSR have shifted towards value chain. Value chain reporting has taken the forefront. and integrating the ESG principles, KPIs across the value chain is complex. It's definitely complex and challenging. And these challenges are faced by clients on a daily basis. Based on my experience of what I have interacted with the clients, key challenges would be, as Bharat mentioned, data collection and reporting. So many companies are still struggling with data collection and reporting, owing to inconsistency of the data or different formats of the data, right? Synchronizing all the data. Second would be engagement with suppliers. So engaging with suppliers and ensuring that they adhere to the ESG standards could be challenging, especially for companies like Bharat mentioned, with a vast, big supply chain and diverse supply chain. Cost implications could be another factor. Uh, Implementing sustainability, as I mentioned earlier, definitely involves a cost and upfront costs, which could be a barrier for some of the companies, especially the SMEs. And then technology integration. So leveraging technology to drive ESG initiatives in the value chain is a challenge, and it's a resource intensive, but with the potential to become a huge opportunity. While a lot of awareness would be required for the to kind of train the value chain partners, upskill them on how to do the reporting, what to report, what data to report, what it is required for, how it is important, how does it bring in value. So all of that would need a lot of capacity building, even if it's driven through technology. Readiness of the companies to manage and report the ESG requirements again varies. Large companies who have been reporting on their sustainability initiatives historically would be kind of better prepared, having already invested in the necessary infrastructure and the expertise and the resources. Smaller companies would lag behind because this is the first time this thing is happening and there would be resource constraints. Many companies still are in the process of enhancing their ESG capabilities. So they could be companies who have already invested in digital tools. They are planning to invest in digital tools, or they are getting their value chain partners trained or build their capacity, or they are engaging with industry forums to improve their ESG reporting and managing practices. So, in summary, while there are significant challenges, but companies are making strides, and the preparation for this entire value chain reporting has started.
No, absolutely. And I think when we do this again 1 year from now, just to take stock on what's been the progress out here, I'm sure some of the challenges we've spoken about today on data collection, supply engagement, technology integration would have moved, way forward in terms of and not as complicated as what it seems, before you start the journey. Coming back to you, Django, can you shed some light on how value chain data streaming and digitalization can really help company address these challenges which we've spoken about, and what is the best way forward for them?
Thanks, Dinesh, once again. So, the challenges are all very well known. Data collation, synchronization. Most important is the whole thing around capacity and knowledge of the upstream, downstream partners. And then to add to all of that, whatever data you get from your partners, you integrate it into your sustainability report, your regulatory report, whether it's the BRSR or the ESRS. And that has to be mandatorily assured or audited and signed off by someone, right? So, fundamentally, if you see, it all boils down to two things. One is knowledge and data. I think the whole knowledge piece can be solved digitally along with large services advisory organizations like GT, working on behalf of the client in the center and then with their value chain. And there are, of course, as you mentioned, good digital solutions to address that. For example, we ourselves have created a very good product which has just come out called the Value Chain Hub. As most people on this webinar would know, and I'm sure you guys know it as well, Gaviva has been digitalizing internal requirements within the boundaries of very large enterprise customers for a while now. So all the work which we have done within the boundary, and when we speak to these clients, we have to now extend it out and extend it in auditable, manageable, repeatable, all kinds of things. So what digital solutions we are developing, and I'm sure others would be doing the same, is kind of we're making a satellite or a mini Gaviva, which a large client can give to each of their supply chains. So for example, if you have someone, as Bharat mentioned, who's an MSME supplier, who's making products out of steel or any other metal, asking him to even calculate his scope one might be a tough task. So digital solutions are there, including ours, which can be extended now to the value chain, where they can do whatever a large enterprise does, report all of that and push it back to the large enterprise. And then the digital platform can consolidate all of that, make it auditable, assurable, and automate that entire workflow. Now, what are the advantages of doing that? Minute you're seeing data flow across boundaries, even within your own boundary, when you're doing emails and Excel sheets, it becomes a tough ask. But once you're going outside boundaries, unless you have a robust digital methodology, which can be tracked, managed, assured, because you yourself are going to get assured on that, it becomes a big challenge. So I think the number one benefit is of having all of this streamlined, managed across boundaries in a very secure manner. The next one, as Bharat mentioned, you touched upon, Abhishek mentioned, is how do you quickly build the capacity? So 150, next year 300 companies have to report on value chain. If you take even a factor of 50, you're quickly touching about 15,000 people who have to come online on ESG parameters. And I think there is no other way to do that, including capacity building using digital tools and platforms. Just to shift the focus a bit, if you look at it on value chain downstream, and now, there was an RBI discussion paper which came some time back, which has mandated banks, large banks, mid-sized banks, to look at their loan portfolio and assess it from a climate risk point of view. And as a result of that, we've seen a lot of RFPs, tenders, interest come out from large PSU banks, etc., where they want to now, conceptualize and implement digital solutions where if they're lending money to a Gaviva or a GT or whoever needs it, they want to first assess whether they're meeting basic benchmarks of ESG norm, but on a continuous basis, stressing that portfolio on climate risks and say, hey, listen, what's going to happen to me? Imagine a bank lending to multiple real estate companies, and for some reasons down the line, because of climate challenges, flooding, non-availability of resources like water, etc., and water-starved places, if that industry starts to default, a large part of that bank's downstream portfolio gets affected. Slightly long-winded, but to answer your question, if you look at it, it's getting serious. It's getting more and more intense. And if you look at the sheer number of organizations and data points and depth of data required, I think there is no option but to go the digital way. And people like ourselves have already started innovating and presenting solutions in that area. Thanks.
No, thanks, Ango. And that is important, that I think without a digital tool, you can't go anywhere. I mean, it is a necessity. But Bharat, I want to just get your perspective, right? How are you seeing, digitalization and technology platforms, and how do you believe that they will facilitate, help on all your ESG reporting, parameters? Is there anything specific which you are already using, you're thinking of? It'd be good to, get that perspective from you.
Sure, the next thing, as Jangu has mentioned, so digitization obviously is pivotal in transforming the value chain reporting process. Now, by leveraging advanced digital tools, we can collect data more efficiently and accurately. We implemented digital data collection and management system within our company, which enables real-time data tracking. It improves our data accuracy and it reduces our manual efforts. Now, further, the cloud-based platform which are available now can also facilitate seamless data sharing and collaboration across various entities in this value chain, irrespective of the geographical location. But that's another challenge. All your value chain partners are spread out, on a pan-India basis. So this not only streamlines operation, but also fosters greater transparency and responsiveness towards the supply chain. So I don't think without digital efforts, this collation of this entire data and management and reporting, will itself be easier task. So I think this is something which is a must and will help you with that.
No, thanks. Thank you, Bharat. Thank you for that. I know we're running short. We're about to come to the end of the time. So just a few quick questions, right? The first one again back to you, Bharat. And we've already spoken about the SEBI's recommendation paper on BRSR. Of course, we are waiting to see what's the final notification which comes from their side. But in your opinion, what else can Indian regulatory bodies do to further support companies in navigating the complexities, especially around value chain reporting or any of the ESG reporting?
So Dinesh, obviously one, as we mentioned, so there's a ease of doing business, survey which has been done and the report is pending. So materiality is obviously one thing which we expect should be enforced. So you cannot apply, this principle across the board to everyone in the value chain. But there are people who are struggling even on a day-to-day basis, and you see the regulatory changes sometimes takes a lot of time and resources from those SME clients. So I think the regulatory bodies need to provide capacity building programs and also maybe financial incentives, especially for this sector, and to encourage those SMEs, within the value chain to adopt sustainable practices and enhance their reporting capabilities. Now, creating a centralized platform for data sharing and benchmarking can further streamline the process and facilitate industry-wide collaboration on ESG initiatives. So I think this field is a must. I think the government must do it if really want this to be successful initiative.
Thank you for that. And with that, just also the last question for you, because I know we come to the end. What do you think is the single most important step companies should take to improve their value chain reporting? Or let's put it this way, what would be the single most step you would be taking as a company to improve your value chain reporting?
See, I think from our perspective, it's very clear, like is mentioned, it's basically the capability building and the training requirement, for the value chain, both upstream and downstream, which is required. And unless the large companies take this initiative, government alone will not be able to do that. So we'll have to take that task. So the thing is, everyone realizes now, because without these ESG principles, I think the continuity of business itself can be at risk. And as we mentioned, today all investors are looking at the ESG rating when they look at the company, and it's not happening only in the listed space. In unlisted space, we have seen, and these things are now, gradually becoming a must. So I think we need to take that lead in both training, capability building, and providing appropriate digital platform to the entire value chain partners, both for data capturing, management, and the assessment of the data.
No, thank you. Django, your view? What's that one single most important step which companies should be taking to improve their value chain reporting?
I think I would like to say two, with your permission. One is awareness, which just includes training, capacity building, and second, obviously, is digitalization. I think both are very, very critical. You need to get your value chain included, aware, and kicked about it, rather than just imposing. Upstream, you're a buyer, so you still have some purchasing power on them. But downstream, you're a seller, so you kind of have to get their buy-in. So that's very important. And then second, as Bharat also rightly mentioned, and so did you reiterate, without digitalization, with the amount of data points in the poll, we saw there are like 61 data points that we need. And if you multiply for average listed top 150 next year, 300 companies, 61 into say even 100 participants, you're easily talking a lot of data points, which obviously if you want assured, ready, quick digitalization. So awareness and digitalization.
Abhishek, 10 seconds to you.
Engagement with value chain partners, awareness, that will help in getting a holistic view of what is happening at the value chain partners.
Okay, no, I think with that, we've coming to the end of the time. I know I apologize, we've not been able to take questions, and there are lots of questions which we put up, but like I mentioned, we wanted to keep these webinars short. And we will be coming with many more such series. However, we will compile the list of questions and we will get them emailed to, we will put down responses and email them to all the participants. I want to just thank my panelists for all your valuable insights today. It is pretty clear that improving value chain reporting is a multifaceted challenge, but it also, presents significant opportunities. Thank you to the audience for joining, taking time off your busy schedules to attend this webinar. Please do drop us a line if you believe you would have liked to hear some different aspects. Please do give your feedback on how we can make them better as we go forward. Have a great day, everyone, and thank you once again for your time.
Thank you.
Thank you.
Thanks, everybody. Good day.